Hello, everyone, and welcome to another edition of Bank Talk with me, Van Hesser. As always, this is Ethan Heisler. Van, how was your Thanksgiving?
Full of food and frivolity. So happy to be back at work.
Well, we had a lot of stuff to contemplate over the weekend, didn't we? We had this notice of proposed rulemaking on the community bank leverage ratio. I don't know if you spent any time.
I certainly didn't do it over the weekend.
I just read the whole thing. I could not stop reading all 144 pages. It was a page turner, sir, page turner. I mean, you asked me to think about this. Bottom line, and the piece that I think I would like to put out here is to say that, from a rating agency standpoint, which you'd obviously know better than me, rating agency standpoint really looks through the regulatory ratios and calculates economic capital ratios.
Let me stop you there because I do think that rating agencies oftentimes will have a very simplistic look at bank capital adequacy. KBRA's view, we think, is very differentiated. So yes, I would agree that we tend to look through the sort of rule, but let's remember, banking is highly leveraged and it's regulated. We take comfort in the fact that it's regulated. You're going to see bank managers congregate around a capital ratio that not only the regulators agree to, but the market agrees to. If you don't take a false sense of security, if something is levered only 10 times versus 11 times. What's so much more important is the ability to produce acceptable margins on a sustained basis through the cycle, right? So a lot of this, I think, falls into the regulatory burden that the industry focuses a lot on. Hopefully this reduces some of that burden and simplifies overly complex yardsticks.
Right. Van, I thought it was amazing looking through the publicly traded financial institutions, and you look at the banks the publicly traded holding companies that do meet the CBLR 9% ratio, generated in the third quarter 12% ROE. So you wonder, okay, wait a minute. You have institutions that are already meeting highly, I mean, 5-10 years ago, if I had mentioned to you capital ratios at 10%, 9%, you'd have laughed at me. No bank had those kinds of ratios.
Bankers believe they couldn't make an acceptable return on those kinds of capital ratios.
Clearly, thanks to the tax cut, certainly. Tax cut added at least 2 percentage points to the ROE numbers. But nonetheless, these institutions are generating 12% ROE in the third quarter is a pretty good sign. Obviously this is the best of times, no asset quality issues, blah, blah, blah. But we'll see where that goes. I thought that, at the end of the day, I have an institution that wants to, the regulators have said, this is a paperwork reduction act. This is really designed to ease the capital burden, ease the regulatory filing burden, not the capital burden for these institutions. And it clearly does that if I only have to calculate one capital ratio as opposed to 4. Look, 30 years ago, we came up with Basel I, right? Basel I was agreed 30 years ago. And back then, if you went and looked at the H8 data or looked at Fed data, FDIC data, you would see that the capital ratios, the average capital ratio for the industry back then was 5%. We're at 11%. Right. So the meaning of a risk-based capital ratio today, the average risk-based capital ratio for the banks that meet the CBLR, the average CET1 ratio is close to 20%. That's astounding to think in an industry that 20 years ago, when it was in the midst of the financial crisis in the early 90s, the one that we all grew up in, that was back then when they were just barely able to make 8%.
Right. So it's interesting. I think investors are out there, and I've heard from some who are worried that this rollback, Dodd-Frank, to sort of put a label on it, makes me less confident about community banks, regional banks, and super regional banks because they're going to have less oversight. This is just starting to roll back some of the excessive regulatory burden. Nobody believes, we certainly don't, that oversight has been or will be materially weakened by some of these actions.
Right. And if you think, well, look, I mean, the reason why we have risk-based capital rules was that banks were gaming a capital rule system that was based on a strict definition of assets. Would banks be moving balance stuff off balance sheet? Well, guess what? If you have significant off-balance sheet obligations, you're not eligible for the CBLR. You're not a traditional, that was part of the conditions to meet for this ratio. So I think all in all, I mean, I looked at this the first time I heard about the CBOR, I was very skeptical. I was in that camp that this is going to encourage risk. But after really going through this thing and seeing what they've contemplated here, I think this is relatively benign. I think it's exactly what regulators build it to be.
Totally agree. Nothing to see here. Let's move on.
So let me ask you, Van, I mean, we had a great conference in D.C. What were your big takeaways?
Well, I agree. I thought we had terrific response, great attendees who witnessed, I thought, a very productive day-long session talking about topical issues in banks at the moment. And, a couple of takeaways. On the asset quality side, we had a couple of panels, one on commercial real estate, one on consumer debt. Commercial real estate, I think we heard from some real estate experts, including our own out of our CMBS group. The fundamentals remain solid. I think there's an acceptance or a belief that a lot of property types and markets conditions are frothy. But in terms of risk to the banking system, we think it's all remains very much in the manageable category for one big reason, and that is construction lending, which was the big problem in 2 of the last 3 recessions. Construction lending has been driven down as a risk concentration in the banking system because of regulatory guidance that started back, I think, in 2013, if not sooner.
Well, the original guidance came back earlier.
Exactly. So I think the regulators have done the right thing here and put a cap, at least in terms of risk to the system, on construction lending. On the consumer side, a lot of this goes back to risk-adjusted returns remain high, right? We've been through a correction now in ultra-low loss rates. We're now up to loss rates that you would expect at this point in the cycle, still on the low side, but the yields have held in reasonably well across really all asset types within the consumer space. I think we feel reasonably good that the consumer loan issue will not get out of hand as it did back in 2008. So if we look forward on asset quality issues, we feel like the banking system is in reasonably good shape as we enter a recession at some point. We'll get there eventually. Who knows when? It doesn't feel like it's a near-term risk. One last thing, we talked about this a little bit on the regulatory side. We had a number of political or policy or regulator views, including Yelena McWilliams, head of the FDIC, heard from both Senator Sherrod Brown and Representative French Hill on sort of the policy-making side. And I believe there's support across political spectrum now to rationalize some of this regulatory burden, especially on community and regional banks. One size does not fit all. Regulation for Citigroup or Bank of America or JP Morgan Chase should be different, in our opinion, than in that of a community bank. So again, we're not talking about a widespread rollback of the oversight that creditors take enormous comfort in, given the leverage in the banking industry. But we do believe there is support now to rationalize some of the regulatory burden that has fallen disproportionately on the much simpler community and regional banks. So those are some of the key takeaways we had from what I thought was a very successful conference. What did you think?
Yeah, Van, I guess the only thing I was left with that whole thing is, yeah, this is all fine to say. I totally agree. I mean, it's reducing paperwork burden, compliance, not the substance of bank regulation. However, we are in a rising rate environment. And historically, every time we have a rising rate environment, you find things out you didn't know were going to happen. And so probably everything's going to be fine, but it's worthy of at least a little wariness to say, okay, I've been through this enough times to know rates going up, not always a great time to be just so everything is great. So I think, if I'm a credit guy here today in this world, I'm a regulator, I'm just going to be extra wary and look a little bit extra. And in that context, one of the big things that you should be worried about is the bank regulator. Look, bank regulation is an important part of credit safety. It provides that extra layer. That extra layer is starting to decline. It has been declining. The number of bank examiners, the number of FDIC headcount, state bank examiners, all of this stuff is declining. And so, when you need banks and the exam schedules are being lengthened to 18 to 24 months and they're being scaled down, you want to find problems. Sometimes those are the times when you miss them. So I don't know. I mean, I think it looks good. My takeaway was like, okay, yeah, but wake me up in a couple of years after we get past whenever this cycle is going to end.
I know. I think banks are cyclicals. We should be conditioned enough to treat them as such. We've been in this expansion now for an awfully long time. We indeed will see, as Warren Buffett has said, when the tide goes out, who is swimming naked. But for now, it's a pretty high tide. We've got some runway ahead of us here from an economics perspective.
Okay, well, I think that does it for us this time. Thank you, everyone, for joining us on Bank Talk. This is Ethan Heisler, and
Van Hester, thanks for joining us.
See you again next month.